Well, hello and a very warm welcome to this webinar, European Banking. Has anything fundamentally changed? Brought to you by Scope Group. My name is Keith Mullin, and it's my pleasure to be your moderator for today's session. Now, clearly, obviously, banks have been the topic of the past couple of weeks. I'm delighted to be joined today by Marco Troiano, who's head of financial institutions at Scope Ratings, and Sam Theodore, a senior consultant at Scope Group, and of course, a former bank analyst and indeed bank regulator. We've decided to dispense with presentations for today. So we're going to do this as an interactive discussion between Marco and Sam, with me hopefully leading them through the conversation with series of questions. We'll also be delighted to take your questions, so please do type these into the questions box on the platform. So that's it from me. We're going to get straight into it. And I'm going to start, Marco. By the way, good morning, Sam, Marco. Great to see you.
Thank you.
Marco, let me start with you. Since your banking outlook that you published at the beginning of the year, you've been pretty consistent that European banks look solid from the perspective of capital liquidity, leverage, etc., and that rising interest rates are, broadly speaking, good for profitability. Given what's happened of late, has your perspective on the creditworthiness of the European banking sector, your base case, changed in the past couple of weeks?
Yes, not really. You might remember that we titled our outlook "Solid Ships in Turbulent Waters." So it's not that we were expecting entirely smooth sailing through 2023. We did flag that we're facing very high uncertainty, especially policy uncertainty, as central bank have to unwind a decade basically of very easy money policy to rein in inflation, and this is gonna of course create volatility. We had also flagged that normalization of liquidity conditions was one of the key factors to look for this year. So to me, we are just starting to see the turbulent waters. So greater volatility, difficult issuance market, fears of contagion. But by and large, I stand by our call made at the beginning of the year. I think European banks are very well positioned for this. They have strong capital, strong, stable funding, good liquidity metrics, and what's more, their revenues are positively geared to the rising interest rates, which is, I think, more than offset some deterioration on the asset quality side. And perhaps, from the past couple of weeks, one element which I think is worth underscoring is that the sector is very well regulated and supervised. When we wrote our piece, I was sort of comparing European banks to large tanker ships, because of the potential for negative externalities, so oil spills and environmental damage. We have regulations around how tankers are built with double hulls and extra protections, and I think it's the same for international regulations around banking. So that's how we think at banks at the moment.
Yeah, good, thanks. Sam, you actually said, I think these are your exact words, there is no rational basis to the view that the European banking sector is in crisis. That thesis is being tested in the last couple of weeks, but do you stand by your comments?
Yeah, I do actually. I don't see any rational basis. I wouldn't call what's happening during the last weeks a banking crisis. I would call it a market turmoil about bank names. But to be honest, I don't see any change in the strong balance sheets and business models of most large. I'm talking about large European banks, not about mid-sized, smaller banks. Those count less, and they're not properly monitored by us in the market. But I think the large banks are still very solid. I've been covering banks or following at least banks in Europe for a few decades, and I've never seen them in such a strong prudential and financial position. And as Marco mentioned, interest rates going up helps their margins, although I would be a little bit more cautious about unmitigated support that these rates bring banks in terms of revenues. We can talk about it if you want later. But no, definitely, I don't see a crisis.
Yeah, indeed. Marco, given that we're a rating agency, I wonder if you could talk in general terms about where Scope's bank ratings are clustered, and perhaps you can discuss your outlooks.
Yeah, sure. I mean, as you know, we have mostly our ratings are available on subscription, our subscription platform Scope One. But in general terms, given what I've just said, quite unsurprisingly, our outlooks are mostly stable. Actually, 85% of our outlooks are unstable, and the remaining 15% is equally split between positive and negative outlooks. So we don't have a clear directional view from where we stand. And perhaps the other thing it's worth mentioning is that Sam was correctly pointing out that we have quite good visibility on large banks, not so much on smaller institutions. That's really true for us. I mean, more than half of our bank ratings are on institutions with more than 100 billion in assets. And when I look at the split of ratings, 93% is investment grade, with only 7% in non-investment grade. So I think we have quite a bit of confidence in the stability of the larger institutions. And there could be weaker names here and there, I think, scattered across Europe, but these are not, of course, going to create systemic issues for the continent.
Yeah, and in terms of if you had to pick a point where they're broadly speaking clustered, what kind of rating category?
Oh, I mean, I mentioned 93% in investment grade. The vast majority is actually single A and double A range.
Okay.
So we're covering all the GSIBs and generally top, 2 to 3 banks in every country.
Yeah. Okay. Thanks. Moving perhaps on to some of the more specific issues coming out of the last few days. Sam, you said in your most recent The Wide Angle report that the regulatory framework for placing banks into resolution as going concerns may be more questionable than previously assumed. Interesting comment, but can you expand on it a little bit?
Well, basically, I find the resolution framework intellectually very elegant, but I'm not sure that in the real world it would work as it was planned by regulators, by policymakers. Why? Because this resolution framework is supposed to have an orderly exit into resolution of a bank as a going concern, or when you have a panic, collapse of confidence, nothing is orderly anymore. So I think the main element in the resolution process is the liquidity support provided by the central bank. If that liquidity support is not there, the resolution process is probably going to be worthless, meaningless. It's not going to work because, again, I think we saw it at the beginning of the great financial crisis, which started as a liquidity and funding crisis at the time on wholesale funds. And then it turned into an asset quality and solvency crisis. And people forgot that actually that crisis started as a funding and liquidity crisis. And we have it now again. The only difference is that now you don't have an asset quality and especially a solvency crisis because capital is strong and asset quality is not that bad. So I think that if you don't take the liquidity element in as a first priority, the rest of the process is not really very relevant. The Credit Suisse situations could have been sorted out through a resolution in Switzerland, and UBS to pay 1 Swiss franc for it, and probably it would have been better in terms of hierarchy and respecting the hierarchy. But at the same time, what really counted it was the liquidity support and the government support for losses.
Yeah. Absolutely. Marco, feel free to comment on what Sam has just said, but I guess one of the follow-up questions I would have about resolution is that if you think about the way that you view European banks, distance to resolution has been a pretty important factor. Given what's happened with Credit Suisse, are you challenging yourself on the way you look at resolution and distance to it?
I mean, first of all, I think I'd second a lot of what Sam was saying. I think the topic of funding in resolution is one of the key missing ingredients there for an operational framework that can actually work. I would add one other element. I think the way it's built, resolution works, even on paper, works quite well when you have an individual banking crisis. But in case of more systemic situations, I think it would always be more difficult to actually put in place. I mean, on the topic of how we look at banks and what our banks' ratings measure. First of all, I think we had the luxury when we crafted the methodology to look at post GFC regulations, and I think I would stand by our view that it's very important to look at regulatory action and to measure, not so much only probability of default for banks, but more generally probability of regulatory action and regulatory intervention, because this is how you lose money as a bank paper creditor. So it's not just resolution. I mean, we've just seen the example of the Credit Suisse 81s. I think that was quite vindicating our approach. But I think one thing I need to stress is that we are not necessarily looking at distance to regulatory action so much as probability of regulatory action. I mean, bank failures don't happen in a slow and controlled way where you're at a certain distance to regulatory action and then you get closer and closer and then you fail. I think at least my experience of bank failures is you always have some sort of jump towards default situation. So the best we can do is to measure how likely this is to happen for different banks, and in particular for different business models, for different funding structures. So I would be very careful not talking too much about distance so much, but maybe likelihood or probability of regulatory intervention instead.
On that score, if I can just jump in, probability of resolution has been kind of thrown up in the air somewhat, has it not?
Sorry, go again.
The probability of resolution, that kind of probability. I mean, I don't know how you calculate probability. It's one of those, I guess, there's a number of factors, but has the probability of resolution been rendered somewhat less clear?
It was always a very difficult concept to estimate. I think we just had another instance where resolution was not actually activated. But in terms of probability of regulatory action, we did gain a data point on regulatory action on the Credit Suisse 81s.
Yeah.
So I think that's what's steering the debate at the moment on the broader 81 asset class, and I think it's part of our job to try and forecast or at least proxy what will drive regulatory action on banks using other elements such as bank fundamentals, business model fundamentals, operating environment fundamentals, which are the building block of our rating methodology.
Yeah, absolutely. Sam, I'll come back to you in a second. But Marco, there's one question that's just come in. It's just more of a data point question, which is how many banks by number or percent with assets above 100 billion are you actually covering in the EU EEA? Can you just give us some kind of how many banks do you actually cover?
We cover 78 different banking groups. I think that was 54%. I looked up this morning, over 100 billion. So I think we pretty much cover every bank or close to every bank with over 100 billion balance sheet in the euro area.
Indeed. Okay, there's a couple of questions about social media, etc. We'll come to those in a second. But Sam, again, this is a question which is not a new one, but it came into relief this past week, which is, I mean, to what extent should supervisors allow their actions to be dictated by the reactions or potential reactions of the market? I mean, second guessing how markets might react is a difficult task at best, but supervisors do need to be cognizant of the impacts or the reactions to their actions, right?
Well, in the supervisory world, there's an expression that has been an expression for long. We want to avoid regulatory capture. So supervisors at all times need to make sure that they keep their independence from market judgment, because their job is not to satisfy market demands or market expectations or to make investors wealthy, Their job is to help maintain financial stability and to look after the bank's depositors and after the bank's safety. Having said that, I think increasingly, especially after the GFC, supervisors are attuned to market impression. I mean, I'm looking at the website of the ECB as a bank supervisor. Very often in the past, less so more recently, but very often in the past, they were talking about the need for banks to improve their profitability, to cover their cost of capital. And, usually a supervisor backs up with numbers, sentences like that. But in terms of cost of capital, I doubt that the supervisors themselves would calculate banks' cost of capital based on market considerations. I think that what's very important is that, and some supervisors remember that at the end of the day, it's the market which will have to provide, if needed, a new equity and new funds to the banks that they supervise. And without those, banks will need to be replenished by governments, which is not an appealing proposition. So yes, they don't need to be dictated by the market, but they need to keep in mind, and especially to be more open and transparent with their views, without giving specific names of banks, of course, with market participants. And I think in this context, some supervisors are more open, and I would mention the ECB, which organizes meetings and have a interactive dialogue with the market, which I think it's to some extent the Bank of England, much less so, I would say, FINMA, and to some extent that contributed to the utter surprise of the market when Credit Suisse collapsed. Credit Suisse was in the news for years for making bad choices and carrying out a bad business, especially in investment banking and some asset management deals. And always they were able to point out, but we have strong capital, the regulators don't object to that. Well, having strong capital is not everything, as we clearly saw last week. So I would keep an eye on the interactive relationship between supervisors and the markets.
Yeah, absolutely. There's a couple of questions which are, I guess, on related topics, and I was going to come to this later, but as it's clearly of interest to our viewers today, Marco and Sam, I'd like to come to it now, which is considering the significant impact from media and social media, how can European banks react to ease this risk? What could the banks do if being under attack like Credit Suisse, and what measures can regulators take considering the liquidity support didn't work well with Credit Suisse? I mean, it's a bit of a big question, but I guess the first part is, I mean, realistically, perhaps Marco, once banks come under attack, I mean, it's not much that regulators or supervisors can do, right?
Yeah, I think this is a very good question. I mean, my view is that, realistically, we look at institutions which are technically insolvent by design in the short term. So because of the function they perform, they transform short-term liquidity into long-term investments or loans. We've long known that if all depositors run to the bank at the same time, the bank will not be able basically to meet all the withdrawals. This is why deposit insurance was created long ago. That obviously is not enough because you have a whole other host of liabilities which are not insured and can lead to a run. So I think this is a little bit the nature of the beast. I think we've done a lot in terms of creating regulations and imposing banks to hold liquid assets to meet at least a large amount of deposit withdrawals, but this is still based on some modeling of rational behavior, under stress, under worst case scenario. But of course, if this goes past to a point, there is no liquidity coverage ratio that can hold a complete type of withdrawal. And I think that's where it's very important to get lending of last resort operations from central banks to the banks, which are potentially unlimited. And as long as the supervision of the banks is strong enough to give authorities the necessary comfort that they're not extending lending of last resort to a bank that will later on show up with problems on the asset side, I think that's where banks should be supported in case of liquidity crisis. It's true that the digital age makes a lot of these decisions very fast-paced, a lot more fast-paced than in the past potentially. But this is, I think, a very crucial debate that we're going to have.
No, indeed. Sam, let me put, I guess, the same question to you. I'm referring to one of the audience questions, which is that obviously banks can be ignited and fueled and based on rumors. I mean, that's always been the case, and they can happen very quickly. The question is, where are the circuit breakers? I mean, you had written in recent days that supervisors, is there anything supervisors can do you think, to put in place any kind of circuit breakers around bank runs?
Well, again, I think bank runs are triggered by liquidity and funding crisis, not by capital. I think supervisors traditionally have been very focused on capital, which is very good, because if a bank doesn't have capital, at least regulatory capital, the market confidence goes away. And if the market confidence goes away, we know what happens. But that in itself is not enough. I think there are two issues here. One is interconnectedness, like the financial system is interconnected. And I think that up to now, the regulatory focus and the policy-making focus has been on the GSIFI, the globally systemically important financial institutions, including banks. And I think that when you have the situation of a butterfly in Santa Clara, California, flapping its wings, triggering an earthquake in Zurich, then you have to ask yourself, maybe this issue of interconnectedness in the age of social media, of global instant communication, needs to be readdressed. And I strongly believe this to be the case. If you limit yourself to the GSIBs and say everybody else is not relevant in the market, you're making a huge policy mistake. The second point, coming back to the need for more transparency from the part of regulators and supervisors, and I mentioned that already.
Yeah, absolutely. Marco, perhaps I'll move on to a related, but perhaps another question about bank capital. Now, if you look at the sort of evolution of the bank capital narrative since global financial crisis, what we've ended up is a pretty complicated situation and scenario with buffers galore, different banks, different buffers, and it's a lot of moving parts. And there's a pretty clear sort of regulatory narrative emerging of late that it's been too complicated for the banks, for the investors, for analysts, and everybody else. Here's the $6 million question, though. Is it time for regulators to actually rethink bank capital from the top down and just simplify the current setup?
No, I don't think so. I mean, this is a discussion that comes up regularly every time you have a crisis, because in reality, when you're dealing with highly leveraged institutions, this is really a game of fear at play here, and complexity doesn't help. Complexity just adds to the mistrust and to the volatility. So every time we have a crisis or a near crisis or a turmoil, these sort of debates spring up. I think the other source in which we get this debate is the risk weighting framework good enough, or should we just revert to leverage ratios, which is a more simple measure of capital? Honestly, I think you cannot oversimplify. These are very complex issues. So if we try to simplify this, we lose effectiveness in a way. Of course, I'm not saying the rules should be set in stone, and there is always probably room at the margin. But I mean, these rules were not created just over a couple of beers. I mean, this has been a very long process, with a lot of stakeholders and consultations and lobby groups, and it's a balancing act of the needs of banks, the needs of investors. Take 81s for example. Can you get rid of 81s and ask banks to fund only with equities? Of course you can, but it's going to be more expensive in the end for shareholders. So short answer is no. I think you have a complex toolkit for complex issues.
Yeah. Okay, that's reasonable. Absolutely. Sam, I want to take you back. You kind of referenced it in a previous answer, and it's just how it's a question of how analysts and investors should look at banks. Now, of course, there are financial fundamentals that are out there, various metrics that analysts can refer to. But you've been quite clear in recent months that beyond the financial fundamentals and other and regulatory ratios, etc., there's other factors, soft issues, culture, business model, risk tolerance, risk management, quality of management, cyber controls, digital footprint. These are very difficult to capture in traditional credit analysis. How can these elements be brought into, let's call it, valuation discussions, if at all?
Well, yeah, I mean, in general, the analysts and investors and less so supervisors, but then, what they do is not 100% transparent. But analysts and investors tend to focus a lot on financial metrics, prudential metrics, financial metrics, especially equity analysts. If a risk cannot be quantified and built into your model, it doesn't exist. We shouldn't talk about it. We should talk about something which can be quantified, included in the model, which serves to valuation. But at the same time, I think what's essential here is not that the bank has strong capital and strong funding structure. What does it do with that capital and those funds? And how does it do it? And that's exactly what you mentioned, Keith: business model, strategy, culture, tolerance to risk. And all these things cannot be quantified to perfection, but still you have a powerful narrative which can be built there. And I remember rating agencies, when I used to be in the rating business, you had difficulties saying we downgrade the rating of a bank because its culture is not good. Well, you have to be more credible than that. And yet you don't have a ratio. What's the ratio of, good culture versus bad culture, or things like that? But definitely this is what tanked, again, coming back to Credit Suisse, which has been an outlier for years in Europe. And each time people said, yes, but, capital is strong, funding is fine, they continue to make money. Yeah, they have some rotten apples there, but hey, other banks had rotten apples in the past and they sorted them out. So yeah. Definitely.
Marco, do you want to have a stab at a response, given that is what you do indeed have to rate banks, you and your team, and perhaps maybe you could reference your ESGD modifier in this context.
Yes, absolutely. I mean, we're trying to capture since a few years now in our methodology some of these issues, and in particular ESG issues and preparedness for digital transition. And these are, as Sam was saying, things you can't really put a KPI on. So the way we approach this is mostly qualitative. We look at how the different business model. First of all, we look at the materiality of the these different factors. For banks, we think that, for example, governance and digital have higher materiality than environmental and social, although the latter two are also increasing. And then, depending on the business model, we look at whether a specific business model is more or less exposed to some specific risks. This could be the case, for example, for physical risk, climate transition, if you're exposed to real estate assets in particularly risky areas, or if you're a corporate bank and you have a high exposure to transition risk in your corporate book. And then lastly, we look at what the bank is doing to try and manage those risks. What are the disclosures? How much of a strategic priority this is for management? What sort of noises that they've been making in the past few years, although especially for the large banks, they're pretty much now aligned, at least in the narrative. And then you have to look at how they put in practice this narrative in terms of actually measuring the exposure and with a view of managing down some of these more risky exposure. But I would say this is definitely one of the areas where having quantitative analysis is almost impossible for now.
Yeah, absolutely. Look, there's a few questions that come in, and in fact, it's on my list as well, which is about deposits. And just perhaps going to run through the questions, and perhaps as I read them out, perhaps Marco and Sam, you can think about what you might want to say. So the question is, do you expect to push towards more standardized disclosures of banks' deposit mix from regulators/investors? How would this one, I guess, for Marco, how would Scope approach assessing the deposit mix of banks, given the current lack of uniformity in disclosure on deposit mix? So that's one. If you hold that thought for a second, and then there's another one, which is, does the assumption of stickiness of deposits still hold, especially in regards to corporate deposits? What could be the possible influence on the LCR calculation going forward? And the last one, and sorry, you can just bear this final one in your head. It's more about the sensitivity of deposits to a rise in interest rates, the much vaunted deposit beta. I guess the question is quite specific. Which countries are more exposed to the so-called deposit beta in your view? So let's just talk perhaps about deposit disclosure first. So it's deposit disclosure, deposit stickiness, and deposit beta. Let me throw that one out there to either of you to come in with an initial response, and I'll ask the other one to follow up.
Maybe I can go first with a few thoughts. So I think in terms of disclosures, we don't have complete disclosures, especially around the percentage of insured versus non-insured deposits. But we do have, in general, quite good visibility on the split between retail and corporate, between sight and term deposits. So we do have a number of dimensions which we can use to slice and analyze the deposit base of a bank, and have a view on the relative stickiness of a deposit base versus the other. I think it's quite typical for retail deposits to be assumed to be more stable than corporate deposits already, so no big surprise there. In terms of supervisory disclosures, I will surely welcome more disclosure on this, but I think it's also understandable that supervisors, of all the effort to improve the transparency around banks, the one area where supervision is not really pushing excessively for more disclosure is liquidity. And I think that's understandable, because sometimes, very high level of disclosures there can actually exacerbate funding crisis and runs on a bank. And then I think there was a question on deposit betas. I think it's quite. Deposit beta in Europe tends to be lower than in the States, because we don't have direct competition from money market funds. I've seen some, a bit of the estimates that the banks have given on the latest results season. We're in the 10s, 20s, in some cases 30s and 40s, but nowhere near the deposit betas for US banks. In terms of which banks have higher deposit betas, it's typically banks in Northern Europe. I think there is a direct correlation between banks that have been better at modernizing their distribution networks and moving more to online transactions. They've closed down branches. They have less capillary distribution. The downside of that is that customers are a lot more digital savvy, and they're also, more prone to basically be price sensitive. And I think that's what's driving, for example, higher deposit beta in some of the Nordic countries, where whether in Southern Europe, where you still have a pretty capillary distribution, you still have an element of captivity of customers, which keeps the deposit beta much lower. Yeah, I would.
Okay, fine. Sam, look, I mean, it's become a very big topic, both stability of deposits and deposit beta. Feel free to comment on what Marco said, but also there's a big topic now, which is perhaps in the US more in the public eye, but here too, in Europe and in the UK, which is where do we go from here on deposit insurance? Do we expect to see? Will it go to the millions as Elizabeth Warren wants? Will it rise in the US and in UK, Europe as well?
Yeah, I think that deposit insurance needs to be, the ceiling needs to be raised both in the US, but especially in Europe. In the US, it's $250,000. In the Euro area, is 100,000 euros, 100,000 Swiss francs, 85,000 British pounds. I think these ceilings need to be, they were set up some time ago. They were raised during the crisis, of course, but they need to be further raised. I think the nature of the banking business changed. We're talking earlier about social media, but I think in general, in the digital age in which we live, it's very easy to people, including retail depositors, especially those uninsured, to switch accounts, to move to another bank. And actually, that's how neobanks have built their base so far. They are not very successful on aggregate, but I think that it's just the beginning. So I think deposit insurance needs to be raised. I think banks need to pay more on deposits. At the end of the day, in Europe, the saver was the collateral victim of the crisis, which survived over 15 years. Why? Because with interest rates zero or very low, savings were not properly remunerated. Now that interest rates are coming up, banks keep salivating. Now interest rates are going to, now margins are going up because you can reprice the loans. How about repricing deposits more than the loans to compensate these savers for having being disappointed for 15 years? So I think that here you have some interesting developments. And again, going forward, I'm not sure that we can talk about stickiness of deposits as long as these deposits don't have insurance, because at the click on an app, you can move your bank account. You don't need to, queue at the branch and move it, physically.
Yeah, indeed. Structurally, Marco, we have seen certain anecdotal evidence. I haven't actually seen the numbers that what happened. Certainly in the US, we saw a flight to, I was going to say flight to quality, but I call it flight to size, which is depositing in smaller banks, morphing or pushing their deposits into the big banks because there's more transparency, better disclosure, better supervision, etc. Do you think this concern is the same in Europe? Will we see a structural deposit shift over time?
Well, I think you have two, at least what I make of the events in the US is you had a sudden realization, or at least a greater realization from some deposits, that the mid-sized banks were not as well supervised as the largest banks. And this is what has created this flight to quality in the States. And then, the second element, which I think is also quite relevant, is that despite these banks being considered non-systemic under regulation, the announcement that the full deposit base will be protected has then created an additional flight from the even smaller banks, which are, probably now perceived as being left out of this greater network of protection. So I think that's quite interesting. I mean, in Europe, I would say, in a way, there is an interesting inverse correlation between the size and type of bank and the size of type of the typical deposits that they hold. In fact, it's the smaller regional banks tend to have a greater percentage of retail insured deposits than the larger banks. So in a way, those deposit franchises are fairly stable, and they're also quite anchored in still very capillary branch networks. I don't think we're gonna see, the same type of flight. Also considering that I think the regulation and supervision of these banks is actually not as dissimilar in the European Union as it was in the US. So in Europe, the threshold for inclusion in the list of significant institutions directly supervised by the ECB is 30 billion assets, which is actually quite low and will capture most regional banks of any relevance basically in Europe.
Yeah.
But I agree with Sam that it's probably not a bad idea to rethink the whole structure of deposit insurance, probably raising the thresholds. It could have implication because in the end, the post JFC, these deposit funds are pre-funded. So it would mean greater contributions from the banks themselves, which means lower profitability again. And I think it would also probably be, I don't know if I could say the nail in the coffin, but surely complicating the politics around common deposit insurance in Europe, because as you increase the amount of protected deposits, you're also increasing the contingent liability to the individual member states. And this is a discussion which is already quite difficult at the moment. It's probably going to get even more complicated if you raise these thresholds.
Yeah, no, indeed. Okay, very good. I just wanted, we haven't actually discussed specifically the decision to write down Credit Suisse AT1s, and obviously there's a lot of stuff out there. But Sam, you have been in a regulatory environment before. I was curious. So after FINMA's decision, the European Union, UK, were very quick to come out and, to all intents and purposes, effectively censure in some way FINMA's decision. This was a quite unusual step because most of the communications are internal. What do you make of the UK EU public response to FINMA's decision?
Well, I think it was very positive because at the end of the day, you have a AT1 market of $275 billion, which was in danger given FINMA's act of putting shareholders ahead of AT1 investors in the priority of claim. So personally, I don't have anything against obviously writing off AT1 if it needs to be written off to save the bank. That's the purpose of the AT1. I have a big problem with shareholders getting money when AT1 is totally written off. And actually, obviously, I'm not the only one. There are now lawsuits. But also, I think that the regulators that you mentioned, they were quite right to immediately come out and reaffirm the priority of claim of shareholders versus bondholders, including the junior-most bondholders, which are the AT1 investors. So
yeah, indeed. Marco, on Monday we had this vicious sell-off in AT1s. On Tuesday we had a snapback, not back to where it was, but we had a pretty good session Tuesday, Wednesday. At this point, with the benefit of limited hindsight, the indications are that the AT1 market is closed, as everyone has to reappraise where things are. But do you think that it will end up repricing the market, not just for bank capital, but general bank funding? Yeah.
No, if I wanted to be a day trader, I'd be in a different job. Markets go up and down. I think what we had is new information coming out at the weekend on a topic where we had very limited data points on how things work in practice. There was a lot of information on how things are supposed to work in theory, hundreds of pages of regulation plus hundreds of pages of securities prospectuses. And, the terms and conditions of these instruments are actually quite clear. These are instruments that are meant to absorb losses in a crisis situation. So I think this week the market was really reassessing the probability of these loss absorption features actually being activated on the down and on the up. And I agree with Sam. The decision to actually pay something to shareholder was, I think, quite shocking to a lot of people. In terms of what it means for the long run, I think not necessarily a full reassessment of assumptions when it comes to bank funding. I mean, in the end, this was a fairly successful, I think, both the US and the Swiss crisis resolution worked decently well in stabilizing the market. And in the case of 81s, yes, probably slightly more expensive, but as the authorities have made clear, this was really a Swiss exception in the way these instruments were structured. So, not new fundamental information about this market. Now, it's not that the market is closed, but keep in mind these are perpetual instruments with calls which have to be done on an economic basis. We are in a higher interest rate environment, so the calls were already not excessively attractive, and I think extension risk has just gone up quite a bit. I think this is also part of what we are seeing this week, as well as more fundamental rethinking of what these instruments are, what the risk in this instrument is worth.
Yeah, absolutely. We're going to close the session in a few minutes. So I think I've been through all the questions. If you have any questions that you want to ask before we close, do type them in now. Otherwise, Marco and Sam, I got one kind of, I guess, a question which is more or less asking you for a closing statement, which is very simply, what lessons are you taking away from events of the past couple of weeks? Sam, do you want to answer first?
Well, obviously a few. I mean, I have a long list, but we don't have the whole day. First, I would look more in my analysis on the stability of deposits. We take it for granted. We used to take it for granted, not anymore. The fundamentals, which count a lot, the power of the narrative. You don't need to, the ratio is not the final point of an analysis, shouldn't be. I think that's a mistake. Another point that I'm taking from this turmoil is that in the past, there was hand-wringing in the market when governments intervene. Not this time. I think people expect and actually welcome government intervention, whether it's in the form of liquidity support, loss support, probably not direct nationalizations, but then the government itself wouldn't want to do that. So I think that the market, the invisible hand of the market, is pretty much gone, at least from the banking industry, and the government's increase in power, not only in Europe, but also in the US, which I think is positive. I'm not sure how this is going to fare in the US if a Republican administration comes to power at some point, but we have to wait and see. And then what I mentioned again, the interconnectedness aspect, which need to be revisited, because no bank is too small not to count. And the last point, I would, because basically we didn't expect this thing to happen. Those people who express opinions about banks, rating agencies, sell-side analysts, independent analysts, we have to be more humble and to accept that we cannot guess the future and make a confident prediction about it.
Yeah. Very fair. Marco, what are your takeaways from all of this?
Yeah, I think I'm pretty aligned with Sam here. I mean, surely, a useful reminder of how fickle confidence can be. And, when dealing with highly leveraged institutions, this can be fatal. So a lot of focus on funding structures probably needed. Also, I think a very useful reminder of why banks are regulated. I think again, this might be the bread and butter for us, but if you go back a couple of months, you'll find the financial papers full of bank CEOs clamoring for a more lenient approach to their distributions or business models. I think there's a reason tankers have double hulls, and there's a reason banks should have very tight rules, because you can't really just trust the captain to steer the ship in the right direction at all times. And and I agree with Sam. I think it's just another demonstration that there is total market failure at self-regulating in this area, and that's where you need government intervention. And then never be too far from my laptop at the weekend. Apparently, that's probably the other lesson.
Yes, indeed. Well, there's lots of activity in the market this morning, so let's see. But Sam, Marco, look, I think let's close the session there. I think that you have some fabulous responses there. I hope you who are watching found that insightful. I think I've got to all the questions. If there are questions that you still want to answer, please feel free to reach out to Sam, Marco, or myself, and we'd be more than happy to circle back to you on a one-on-one basis. I don't think we've seen the last of the volatility in the market by any stretch. So like everyone else, we at Scope are watching events very, very closely, very carefully. And in the light of events, we may come back in short order to do another session like this. But in the meantime, do look out for the FI research that comes out on the Scope Ratings website. Both Sam and Marco have been active in publishing comments in the past week or so. So it's www.scoperatings.com, and there you can see all of the Scope franchises. Click on the franchise, and then there's a button also for research. So I think that's time very well spent. So Sam, Marco, thanks again, and thanks for watching, and we'll see you again soon. So it's goodbye from us.
Thank you very much.